Okay, so let's jump into it. Let me share my screen. Okay, let me share my screen. Can you see my screen?
No.
It's still presenting. Yep.
Yeah.
Okay. Okay. So let's jump to it. Okay, this is the recent price action that we are currently looking at. Where is it? Okay. So this is where the price is at as today, right? This is daily. So
This is fair.
pardon?
Which
Pardon?
pair?
Oh,
Which pair?
this is the
It's which
USD.
pair?
This is USD franc, Swiss franc, USD chef.
Okay.
Yep. So remember rule of the thumb, we start by our directional bias. So our directional bias, we rely with 1 month because at the end of the day, it's the one that has a lot of force. So if the monthly is selling and then you go down to, let's say, weekly or daily, that means, and maybe the daily or maybe weekly is buying, then you need to be careful where you cannot hold your position for long, because that will mean that the price action in monthly, which is a higher time frame, can have more force to change the direction of your daily. So you need to be careful. That's why we start our direction of bias by going to the monthly. So remember what we discussed yesterday, that price does not move in a straight line, but it moves with a series of higher high, then low. Then this will qualify to be a low if it causes the break of the structure to the upside. Then the price, there are people who are going to liquidate their position. There are those who are going to close some of their position. So that's why the market retraces, then it moves up. So assume this is our monthly leg, right? So where will we see, where will be our liquidity area? So our liquidity area is this liquidation process, this retracement. This is the areas where we find our liquidity. And what is liquidity? We say that liquidity is the unfulfilled orders. And we say that we are the retailers who are trying to benefit by entering the market with our $20 account, but there are these big banks that are opening, let's say, 1 million position at the same time. So, and in every buy order, you must have a sell, and in every sell order, you must have a buy. So you can imagine a bank goes with a 1 million buy orders, and only we have, let's say, 10,000 retail traders who have opened the opposite position. Then that means most of the market will go, and then just to align ourselves so that we can benefit. And that's why we need to understand where are our back, it will come onto that place before. For example, our liquidity, the body, if you are in an uptrend, you mark the weak spot. So you mark the weak. So this means that the upper, for example, is at this level. First of all, you'll have to identify where is the market gaining the loss, right? What you'll do, and observe liquidation. So frame what you want to see. We want to see the market. We want to see that because we are expecting market to come out to this, we position ourselves to buy, break this break market to go back to until it. So that's what we want to go. So let's say daily, go to daily, you find out that the market has shifted, because in a not close below this low. So but go to the daily time frame, you want to observe what is happening at that point. You want to see, because our market has broken to the upside, and we understand the market will not continue that way, but it will retrace back to come inside our monthly liquidity area. It grabs more liquidity, and then it turns to the upside to continue the momentum. So but the market will not just retrace in a straight line, and we will not just wait because the market is here. We wait maybe that our market reaches this point, then we look for opportunity to buy, because this might take even a year. So it depends with how maybe the market will move, and maybe the kind of liquidity that will be there. So we cannot just sit there waiting. We want to benefit with this, riding the market until it reaches inside liquidity area. So how will you benefit at this movement and yet the price is here? You go to daily time frame, you observe the liquidation, you observe if there is any shift from buying to selling in a daily time frame, which is a lower time frame, right? So once you identify maybe the market has shifted, you can mark. If it has not shifted, you can mark the point where if the price break below and closes below that point, then that has given you a signal that the daily has shifted and the market is ready to come back to our liquidity area, right? So once, let's say, for example, let me delete this one. So let's say, for example, our price is here, right? So let me say our price is there. But when you go to daily time frame, you find out that the market has been going this way. So, and your market is at this point, right? You find out that your market is you go to monthly, you find out that this is your current price. When you go to a lower time frame, let's say for example a daily, you find out that the market is in this position. There is nothing. The market in daily is aligned to what is in monthly. So this does not help you to make any decision, because at the end of the day, what we expect, we want to ride the market to come back. So, and we cannot force the market. So what you'll do, you just come here, you grab your this is your recent low. So you mark your low, the point of invalidation. If the market closes below this point, then that means that we are now ready to look for sell into the monthly liquidity. So for example, after a few days, you find out that, for example, it came into this point and it retraces, but does not low. So what will be after waiting? So it's validating on trend. So what you can do, you mark the daily formation here. You mark the body trade, then you mark the high. So this is now you go now to lower 1 month. You find out you are point once you have just a trade here. Then if you can see, this is a very high. Your stop loss is 0.01. That will mean that you'll people who are trading our dollar, our entry side, that at least we can dollar stop loss side that which is in 1 hour time frame. What you want to liquidity area, right? We want to see what is happening, but this is the daily liquidity area when the market was going, maybe going this way, going this way, going this way. You remember this is under the daily liquidity area. It comes and break our low, which is the daily low. So what we expect, come and mark your 1 hour area of liquidity, which is the first high. The shift happens here. The shift happened here. Sorry, shift happened here. Then that means we mark our outside formation, which is this point. You mark the body, and then you mark the high. So, and that means, let's say, for example, that happened here. So this is where you will enter your trade. Let's say you come here, you grab you'll enter at this point. Then your stop loss will be at the wick of that outside formation. So, and if you realize that, you'll maybe find out that your stop loss is, or maybe your pips that you'll be losing, maybe let's say 10 pips. And then what we expect now, that whenever our market goes back, it will come from this point. Let's say it go this way, this way, this way, this way. Then it taps into our entry and then it shoots down. So, and that's what we want to go and observe in our chart. Is it understood?
Yes, teacher.
Yeah, so we can go to the real chart now. So let me remove the drawings. Okay, so we still have some few minutes. Okay, so let me. Okay, so we have our, let's assume we are at this point. Let's assume, let me cut, sorry. Let me cut. Where is the cut? Sorry. So let me assume that you are at this point, right?
Yeah.
So this is USD CHF, the Swiss franc. So imagine today you have come to the market, right? And this is how your market is looking like. So what you are interested, we are interested in this leg, because we are in the currently it's 2 years or 3 years. That doesn't mean a price action that you can see, right? So I was making a series of lower low. It is breaking the low. So sorry. So right.
Yes.
Then another one happened here. So we agree that our general direction in the market is selling, right? So every order that we'll be looking will be, if we can find an order that is in alignment with the general market, this is the monthly trend. So if you find the sell orders, that means that the probability of that trade being successful is very high, right? So, and we say that okay, so let me delete. So let me do this. Sorry, why this not picking? Sorry. Give me a minute.
Okay.
You can't see my screen, right?
Mm.
You can see now, right?
Yeah, I can see.
Okay, so we want to mark our, so we want to mark what was that. So, and as you can see, let's mark here. So this was our, this is where the, right? Are we together? Because this goes up, this was the uptrend, broke, and that was a signal that our market has shifted from up. The shift happened at this candle. So for a shift to happen, we have, and it closes below. So this is not a shift, though this week we went below this low. So this is where the shift happened, right? So, and after the shift has happened, we will benefit more if we can find the second the formation, right? So we mark our area of liquidity, we mark this point. So we mark the high here. Sorry. We mark the high, and then we mark the body, because this we are selling. So you mark the body, the close of the body that way. So this is our this area is our monthly. Let's say this is our monthly liquidity area. This whole region is our monthly liquidity area. So what have we achieved so far? We have identified our directional bias in a monthly time frame, which is we have identified that this is in our downtrend because it is breaking the lower low. And then we have identified our area of liquidity, which is this outside formation. After the market broke the structure, then it retraces and then it finds the impulse to break. That means it broke the structure second times to confirm that this is now a consistent downtrend. So this is where we will aim. If the price will manage to come from this point and then return to this point, that will mean that we'll look for opportunity to sell. So, but since if you can imagine from this point where the current price is, sorry, if you mark this point, then let's say the market return up to this point, that is 606 pips, which is a lot of which will take, let's say, some months, let's say 4 months for price to come back to this point. So what will you do? We will not just sit there down. We'll just have to look at the current price and look for opportunities for market to shift from selling to buying, and then we ride with that until we reach to the liquidity area. Then once we reach at the liquidity area, we can look for maybe opportunity to sell. And then now we expect the market will come with full force to break the monthly low. So let's mark our current price. Our current price is here. Sorry. So this is our current price in monthly. So that's our current price. So if we go down to daily, we want to observe what is the market doing at the current price, right?
Yeah.
So So we want to see where was the last harvest, then that will mean that we have changed our direction from the downtrend. This structure, it retraces, it came down, but if you can see low, is low, right? So that is not
Yeah.
a break of structure. Then this other price came towards the low. It made the low. This does not qualify what we can see, which is clear. Our clear point was this point that caused the where the price managed to come and our market will have shift. But if it is close to our liquidity area, so even if the market move back to this point and then it go back because it area. So what you can do, you can just play reaches our liquidity. You can see the it's okay. So we want to look at the opportunities break here. So our market is just at that point. Sure that the market will not return to this. The invalidation point and the liquidity area was too close. So the market went. We want to look at this month frame, right? So point, this structure. So this was the last low that was printed because this low this body closed closing price, this one. Yeah, so this was the last. Then flows above this one. So then that means that the price changed at this point when the price closed above this one. So this is the price that caused the change of direction from downtrend to uptrend. Then the market did not manage to make this to the other part. So this was there was a break here. There was a break here. There was a break here. Then the market retraced. So these are our now in our new formation. New formation. You mark the high. Then you come and mark the body. Then you come and mark our body, of which when the price break below this point, we expect it to return to our new formation. So that's our point. So, but if we can see, it is not that clear, right? So what we can do, if it is not clear, you go back to 1 hour. Because we cannot say where will the price, it has refused. Okay. Have you encountered that this is now the reason if you have not paid for, you cannot go back in time for many times. So, but you have to pay. So because mine is just free, no problem. So let me do this. Sorry. Bye. Okay. So let's do this way. Okay. So that's the problem that I was encountering. Unless I have to pay. So you go back. Let's use this point. So let's go back. Let's go back. So we are at this point. I had marked my daily new formation, right? So that was our daily news formation. So we want to understand what is the price telling us in 1 hour, 1 day, 1 hour. Can it give us the entry point? So we started from here. So this was the last low. Then the market came and break this high. This was the high that caused this break. So it came back and break, but the market did not come back. So then it moves. Then this was the last high that the last higher low. Then the market break, it returned. Then it returned in form of uptrend, of which it broke down, then go back, of which no problem. So all these points, we don't have any area of liquidity because the market has been returning back and eating all the liquidity. So the market reached this point, liquidity from this, after it's not easy for you to. So then okay, to break this low, then it broke down, the market made a high here, then it come back, then, sorry, I don't know, it's okay. Our time is high. It's okay. So let me delete this thing. I think it is I. What is this doing? Where is the delete? Okay. Taking so much time to delete. If I very clear, I don't know if it will allow us, we can go back to and see this price act. Let me see if we can go to 15 minutes. I don't know. I don't know. Hope it allow us. Oh, it can't. Unfortunately, you have to pay. Okay. So let me Sorry, so let me finalize.
Yeah.
I'll have to look for ways to being so difficult. This is a problem we used to. Yes?
No.
You
I
can't?
can't.
You
I
can't see me?
can't. I can't see. Yeah, it's okay. It's okay.
Okay. Let's just rely with what we can do, because 15 minutes, I think if we can go back, if we could, it could have allowed us to go to 15 minutes, this thing would be clear. So this was how the market was moving. So it moved this way, come back, but not managed to close below. Then it moved up. Then it came here. Then it moved up to make our point, our point of, let's say this is our new formation, right? As you can see, there was a impulse move with one candle, right? So that this means there was a lot of force. That means there are some sellers that remained at the top here. So you mark that point, and then your stop loss is here, because this is our smaller time frame. So what we do is just after we mark that out our entry, so we go back to time now, and then what we expect that our price came and then tap that point and then sells. So I think that's what we have learned today, though it is not that clear though, but yeah. Okay. Okay.